Hello, all. Welcome to today's session about investment declaration and proof submission for your income taxes. My name is C.A. Shoykot Roy, and I have been a part of ClearTax for past 4 years. Today we have Rahul with me, who is an experienced tax professional. If you have any question regarding any of the topics that we are discussing, you can drop those questions in the chat box, and Rahul will be answering them. And we are going to hold a question and answer session after presentation is over, and over there we are going to answer certain questions as well. Now, without further ado, let's look at the subject matters that will be discussed today. Firstly and foremost, who should be declaring their incomes, and why should one declare their investment, right? And what can be declared, what will be the proof of that, and when to declare those proofs. Now, and what happens if you do not submit the proof? And finally, we are going to have a little bit of understanding of certain things that we should keep in mind during the year. Now, firstly, we are going to take a look who should declare their investment and why. Now, uh, let's try to, before we go ahead and understand who should declare their investment, let's try to understand how the taxes work, right? And how these investments are impactful for taxation. First of all, as per Indian income taxes, if your taxable income is more than 2.5 lakh rupees, in that case you should be filing your income tax return. However, if your income if your income is more than 5 lakh rupees, in that case you are supposed to pay the taxes. Below 5 lakh rupees, yes, you are supposed to pay the taxes, but there is a relief going on for those people because your income is not crossing that threshold limit of 5 lakhs. Therefore, if your income is more than 5 lakh rupees, then you are supposed to pay the taxes. Now, this payment of tax can happen either via TDS or by payment of taxes from your own pocket. Either way, this is fine. Now, let's try to understand what does this investment impact? How does this investment impact in tax declaration, right? Now, income tax department or the government of India to create certain incentive to create good habit of saving introduce certain sections in the income tax act wherein if you are investing in certain instruments you will be given a benefit of saving the taxes. Now this is why the inception of various sections under which tax saving investment can be declared and can be deducted has been uh, envisioned, right? They were conceptualized and implemented. Now, what are those areas? Initially, uh, life insurance policies, tax saving FDs. So all these areas were uh, presented as a tax saving means. However, the real idea behind all of this is to make people of India a little more savvy towards saving the money for their retirement or any other purpose for that matter. But to incentivize this good habit department, the income tax department, they have introduced this deduction, right? Therefore, if you are investing in certain instrument, they will be having a side effect of reducing your tax liability. Even though nowadays the side effect has become the main effect, and therefore people tend to invest in those particular instrument just to save the taxes. Building the wealth, getting a return, that has become somewhat secondary. Now, if your salary income or any total income for the matter during the year is more than 5 lakh rupees, in that case, you should most definitely declare. Why? Again, the purpose for declare nowadays is to reduce the tax payment. And if your total income is falling below 5 lakh rupees, you are not supposed to pay any taxes. Therefore, if your salary income is more than 5 lakh rupees, then you should definitely declare all of your investment. If it is less than that, you can certainly declare, but it will not be having that much of a benefit. Secondly, people who are opting for old tax regime. Now, as we know, in India, there are two tax regime parallelly running. One is the new tax regime and one is the old tax regime. New tax regime is for the people who do not have any sort of investment, right? They are given the benefit of lesser tax rates in multiple slabs. However, in the old tax regime, you still get the benefit of tax saving deduction and expenses, but the tax rate and the slab is quite large. Also, the primary purpose of investment declaration is to save taxes. Now, let's say there is a person who has a salary income of 7 lakh rupees and has no investment. On the other hand, one person has again a salary of 7.5 lakh rupees but has a total declaration of 1 lakh rupees, right? So the first person would be paying taxes on 7.5 lakh rupees and the other person would be paying the tax on 6.5 lakh rupees. Therefore, you see it has a direct impact on saving the taxes. Therefore, one of the most important and primary reason to save the investment or rather declare the investment is to save the taxes. Also, uh, another thing that can be done, that is declaring the income. Now, this may seem counterintuitive that I have multiple sources of income. If I declare those money, then what will be the benefit? Now, first of all, you are supposed to pay your taxes on all the incomes that you have, right? So you may have, along with salary, some FD interest. You may have savings bank account interest, maybe some dividend, maybe some capital gains, etc., etc. However, looking at it, if you are only declaring your salary income, your employer is only considering your salary income while computing the TDS. What they will do is they will only consider that source of income, that is salary source of income, and computing they will be computing the taxes on it. However, if you declare other sources of income to your employer as well, they will be considering all those sources. They will be coming up with the correct tax computation. Now, what will happen if you declare all this income at a later stage? That if you declare all this income at a later stage, then is no, on top of paying the income taxes, you would end up paying some interest as well. Now, if you declare all this income to your employer, what they can do is they can deduct the requisite amount of taxes so that you can save on paying of interest. So, along with the declaration, it is advisable you declare your other sources income to your employer as well. Now look at the tax saving expenses. Now, tax saving expenses, there are today we are going to talk about three tax saving expenses. These three are house rent allowance, leave travel allowance, and interest on home loan. Right. Now, house rent allowance, this is a very unique feature, or rather very important feature, and people has various kind of misconception about house rent allowance. The biggest one in respect of house rent allowance is the actual amount of rent that I am paying, the entire amount can be taken as deduction as HR. However, this is not the case. You can get a certain amount deduction as HRA from your salary. Now, these amount is computed based on a income tax. While computing HRA, deductible HRA, there are three figures, three numbers we need to look at. Number one, 40% or 50% of the basic. Number two, actual amount of HRA that I have received. And number three, the actual amount of rent that I have paid minus 10% of my basic salary. Whatever number is least among these three, that amount will be considered as deductible from my salary account, and that amount will be HRA, my actual deductible house rent allowance. So here lies a question: what is the meaning of 40% or 50% of the basic? Now, if you are staying in a metro city as per the income tax act, then 50% of the basic will be coming into picture. Otherwise, for the all other cities, 40% of the basic will be coming into the picture. Now, metro cities for this purpose is Delhi, Mumbai, Kolkata, and Chennai. All the other cities like Bangalore, Pune, Noida, they are not considered as metro cities. Now, the leave travel allowance. Leave travel allowance is again a tax saving allowance which you can consider, which you can deduct while you are traveling. Right? You are taking a vacation, going someplace within India. That amount that can be claimed. However, there's again certain caveats to that. Number one, the travel should be within India. Number two, you can take your dependent spouse, your dependent child. Number three is the expense is only for the deductible expenses is only for first class air train journey or economy flight. Meal expenses, hotel staying expenses, cab expenses, all these expenses are not allowed. Only to and fro expenses from your place to the place of visit is allowed as deduction. Leave travel allowance, however, can be claimed twice in a block of 4 years, right? So this is from 2022, and I strongly recommend leave travel allowance because after 2 years of hiatus, travel has opened up. People are going out of their homes, meeting new people, visiting new places, and along with that benefit, if I can say, there is is allowed as deduction. Finally, interest on home loan. Now, interest on home loan is also another excellent example of tax saving expenses. If you have taken a home loan to purchase a house, and that house is self-occupied house property, in that case amount of interest that you have paid home loan can be deductible up to 2 lakh rupees per year, right? But to claim this deduction, there are certain conditions that need to be fulfilled. Number one, the house must be completed, and you should be the possessing that particular house. Number two, the maximum amount can be deductible, that is 2 lakh rupees for self-occupied house property. Now, there comes a situation wherein I have bought a house, but the house is yet to be completed. So, what will happen in that case? To which the law is pretty clear: until and unless the house is completed, unless the house is completed, you cannot take benefit of that home loan interest. Extends you an option to accumulate all the interest that you have paid till the time till the year of its completion of the house, and you can claim that amount in 5 equal so that is you can accumulate the interest on house property and claim the deduction for it over a period of 5 equal installment or 5 equal years. However, please bear this in your mind that the total amount of interest that can be claimed is 2 lakh rupees. That means the interest paid for the year plus accumulated interest both cannot together exceed 2 lakh rupees. Now, while we are in the subject of home loans, let's dive in to some smaller things that may save you some taxes. One of the most important thing that people comes to us is I have a home loan and I also stay in a rented place. Can I claim HRA and interest on home loan both? To which it can be advised that let's if this is a situation that is being applicable for you, let's say you are staying uh, in a different city from your hometown for your employment purpose and you have taken a flat on rent in your place of work or city of work and you have built or acquired a house property in your hometown where your parents are staying. In that case, yes, most definitely HRA and home loan interest can be claimed simultaneously. Second question that comes to us is I have a home loan, but the home loan is under my name as well as my spouse's name. The house property that I have bought, that is also in my name and my spouse's name. Can both of us claim the interest benefit? To which the answer is yes, both of you can claim the interest benefit. If the loan has both of your names and the house or the flat has both of your name. The catch is the interest will be split evenly between you two. So if your spouse is co-borrower of a loan, housing loan, and the house is under both of your name, then you can take the benefit equally in both of your hand. Now, all these expenses, the interest on home loan that can be taken under section 24B as loss from house property. However, there is another section that is specifically targeted for first time home buyers, that is section 80 EEA. Now, to get additional deduction, that is the maximum amount of deduction that can be claimed under 80 EEA, 1.5 lakh rupees, you need to fulfill again certain conditions. Number one, the loan should be from a banking institute. Number two, the loan should be sanctioned, properly sanctioned between 1st of April 2019 till 31st of March 2022. And thirdly, the stamp duty value of the property should not be more than 45 lakh rupees. If all these conditions are met, then you can get a deduction of 1.5 lakh rupees under section 80 EA, which is on top of 2 lakh rupees of deduction under section 24B. Moving on, let's take a look at the tax saving instrument under 80C. What are the tax saving instruments? Now we have talked about tax saving expenses. Now we are going to talk about tax saving instrument, the deductions. Now, first and foremost, EPF, Employee Provident Fund. Every month, your employer deducts some amount of money from your salary, and they deposit in PF account, right? So that is EPF. Furthermore, there is another option that is voluntarily PF account, voluntary PF Provident Fund account, that is VPF. Now, VPF you can consider contributing through your employer. And finally, PPF, Public Provident Fund. It is a scheme operated by the government, and you can deposit the money in PPF as well. However, there is a uh, investment limit of 1.5 lakh rupees under PPF. Children education fee. So if your children is attending any school or college within India, then any fees that you are paying for their admission or education, that can be deducted. However, any donation or developmental fees are not deductible. Furthermore, life insurance premium, any amount, any policy that you have taken from the insurance organization, that can be claimed as deduction. The policy can be either in your name, your spouse's name, or your dependent children's name, and you can claim the entire amount in the year of payment, the premium amount in the year of payment. Further down the line, we have principal on home loan. We have talked at length about interest on home loan that can be claimed under Section 24B. However, while paying the home loan EMIs, you are supposed to pay the premium amount as well as the principal amount. Now, the principal amount can be claimed as principal on home loan, that will be coming under 80C. And this amount is only allowed if the loan is taken from a banking institute. Further, all the other conditions like the construction of the house is completed is also applicable for principal on home loan as well. What are the other tax saving instrument under ATC? Uh, Pension plan, if you have taken a pension plan or annuity plan, then again that can be considered under section 80C. Contribution towards NPH, National Pension Scheme, that is also deductible. Employer contribution under your name towards National Pension Scheme, that is also deductible. And finally, if your contribution is solely towards National Pension Scheme, then you get a additional deduction of 50,000 rupees over and above 1,50,000 rupees. That is the limit for section 80C. Now, let's try to understand this point. Let's assume your PF, your employer provident fund, for the year is coming to 50,000 rupees. Your home loan principal is again coming to 1 lakh rupees. And you have also contributed towards National Pension Scheme amounting to 60,000 rupees. Now, under 80C, you will be able to take benefit of PF contribution and home loan principal amounting to 1,50,000 rupees. However, you have since you have invested in National Pension Scheme (NPS), you will be able to take another deduction of 50,000 rupees. Therefore, in total, your total deduction will be 2 lakh rupees for that particular year. Now, having said that, having talked about the deductions and everything, let's try to understand uh, whether these amounts are beneficial for you. Declaring all these things are beneficial for you. To which we are going to compare the old tax regime and the new tax regime. Now, as we all are aware, under the new tax regime, no deduction is available. However, the benefit of multiple slabs at a smaller tax increment is present. Under the old tax regime, all the deductions are present, all the deduction can be taken. However, uh, the rate of taxes and the slab is quite high, right? Now, we are going to look at the scenario with an example. Over here, we have an example wherein the salary is broken down in three components: basic salary, HRA, and other allowances. Right? And rent paid in Bangalore is 2,40,000 rupees. We are assuming that person is staying in Bangalore. Right? Now, under the new tax regime, my taxable salary will be 10 lakh rupees. However, under the old tax regime, even though my gross salary is 10 lakh rupees, I can still get a benefit of 1,90,000 rupees of HRA. Now, this amount of HRA has been computed based on the discussion we had before. Right? Under the old tax regime, again we will be able to claim 50,000 rupees as standard deduction and professional taxes or tax on employment amounting to 2,400 rupees. Right? So considering everything, my total salary is coming to 7 lakh 57,000 rupees under the old tax regime, and under the new tax regime it is still 10 lakh rupees. Now we have made certain amount of investment, right? We have made an investment in life insurance, ELSS, SSY, Sukanya Samriddhi Yojana, and made an investment in medical insurance as well. So under the new tax regime, I will not be able to claim any of this, but under the old tax regime, I will be able to claim every single one of them up to their respective limit, which would give me a total taxable salary of 6,19,000 rupees. Now we can see there is a significant gap between the taxable salary between these two regimes. This is simply because I have the ability to deduct much more items from my taxable salary under the old tax regime. Now, again, under the let's look at the tax computation. Up to 2,50,000 rupees, there is zero tax as the tax rate is zero. From 2,50,000 to 5 lakh rupees, the tax rate is 5% under both the regimes. Therefore, the tax amount will be 12,500 rupees. Now here the new tax regime diverges from the old tax regime. So from 5 lakh to 7 lakh 50,000 rupees, the tax rate is 10%. And from 7 lakh 50,000 to 10 lakh rupees, the tax rate is 15% under the new tax regimes, which would give us 25,000 rupees and 37,500 rupees respectively under the new tax regime, which will cumulate to 75,000 rupees of tax under the new tax regime. Now let's look at the old tax regime. Again, up to 2,50,000, no taxes because the tax rate is zero. From 2 lakh 50 to 5 lakh rupees, the rate is 5%, so it will give me 12,500 rupees. However, beyond 5 lakh rupees, there is only 1,19,000 rupees available additional income over 5 lakh rupees because I was able to deduct all the other tax saving expenses and deductions, right? So only on 1,19,000 rupees, I will be paying tax at the rate of 20%, which would be around 21,000 rupees, right? So all in all, my total tax payable will be 36,000 rupees under the old tax regime. Including cess, my total tax payable will be 37,000 rupees as compared to 78,000 rupees the under the new tax regime. So there is a straight cut saving of around 40,000 rupees under the old tax regime. Now, this slide we have had a discussion beforehand. I don't mind going through this all over again. So if you are again contributing towards NPS, you can get a deduction of 50,000 rupees just because you have invested in national pension scheme, right? Assuming you belong on the 30% slab rate, you can save around 15,600 rupees, including the education cess, health and education cess. And finally, we are going to go through what are the tax saving options available for me beyond ATC. So there is health insurance premium, which is, I believe, very much prevalent and important uh, because of the situation that we have faced in last couple of years. Uh, if you have taken a medical insurance policy for yourself, your spouse, and your children, then 25,000 rupees is allowed. If you have taken a policy for your parents, then again another 25,000 rupees is allowed as deduction for premium payment. However, if your parents are senior citizen, that is, if they are 60 years more than 60 years of age, in that case, the limit extends to 50,000 rupees from 25,000 rupees. Now here comes another question that one of my parent is over 60, another is less than 60. So what will happen to it to both of them? To which, since one parent is more than 60, the extended limit of 50,000 rupees will be applicable for both of them. Finally, if you are supporting a differently abled family member or you yourself are a differently abled person, in that case, you can take a deduction of Section 80DD or Section 80U for yourself. Now, there are a couple of things I would like to remind you about declaration. First and foremost, the declaration of investment and selection of regimes can be done at the beginning of the year. Now, declaring the investment does not mean that whatever you have claimed that has been approved. Declaration means you are letting your employer know that during this year, this is the amount I am going to invest in certain tax saving instrument, or I will be having this amount of tax saving expenses. And while computing your taxable income and tax on it, your employer will consider every single information that you have provided, right? However, again, this declaration comes into prominent picture when you switch the job during the year. Now, if you are switching jobs during the year, you have to declare all the tax saving expenses and everything to your current employer all over again. Also, while making this declaration while you are switching the jobs, please make sure you declare all the earnings and tax deducted on it by your previous employer. Because if you do not declare it, your present employer will consider this to be your present first employment for the year, and they will consider all the tax saving declaration, all the basic exemption limit, all every single thing. And since all these things have already been considered by your older employer, it will be counted twice. Therefore, there is a chance you would end up paying lesser amount of taxes by way of TDS deduction. And when you are finally filing the income tax return for the year, you may end up paying additional amount of taxes along with interest. So make sure while switching the job, you declare the income, the regime, and previous employment's earnings and taxes to your current employer as well. Now, if you have, what happens if you do not submit the proof? If you do not submit the proof, then your employer may deduct higher amount of tax from your salary without considering the declaration that was done earlier in the year. However, if any claim is disallowed, right, that amount can be claimed at the time of filing your income tax return. So even if you miss the window of opportunity, you can have the claim at the time of filing the income tax return, right? So uh, as of now, we are at the end of our session. Now we will be opening up the floor for question and answer. So let's have it. Right. Uh, so I don't think there are any questions. So thanks for joining with us. It's been lovely talking to you. Thank you so very much. Have a great day.